For most active business owners in Canada, the Canadian-controlled private corporation, or CCPC, functions as the primary structural engine for holding and reinvesting corporate earnings. This chart compares three distinct tax rates under Canadian law. When a CCPC earns active business income, it benefits from a highly favorable tax rate of approximately 12.2%. Non-CCPCs face a general corporate rate of about 27%. But if a CCPC earns passive investment income, the rate spikes to nearly 50%. That structure works perfectly while a company is actively operating. The friction begins when the business experiences a major liquidity event, like selling off a massive asset or generating significant passive yield from a cash surplus. The moment that income is classified as passive, the corporation is hit with that punitive 50% tax rate. Deliberate and precise tax planners are actively bypassing this 50% penalty by deliberately stripping their companies of CCPC status just before a major capital gain is realized. The mathematical difference between a 50% tax on passive income and the 27% general corporate rate equals millions of dollars on a major business exit. That differential drives an entire industry of structural legal manipulation. When people hear about wealthy business owners avoiding Canadian taxes, the assumption is usually that cash is being smuggled into zero-tax offshore bank accounts. Canada's tax code already has a severe mechanism designed to block that exact behavior. This comparative table illustrates exactly how Canada's Foreign Accrual Property Income, or FAPI, regime treats that money. Under traditional offshore planning, moving passive assets out of the country triggers the FAPI rules. FAPI forces Canadian shareholders to pay tax on that offshore passive income on an accrual basis every single year, immediately eliminating any deferral advantage. The non-CCPC strategy operates completely differently. The money and the physical assets never actually leave Canada. Planners rely entirely on manipulating domestic corporate definitions rather than altering the geographic reality of the business. The target state for these advisors is to convert the business into a Canadian resident non-CCPC. Once achieved, the company is subject to the general corporate rate of approximately 27%. By keeping the capital within the Canadian tax net, but surgically altering the legal label attached to the corporation, planners bypass FAPI entirely and access the 27% general corporate rate. To understand why owners go to such lengths, we have to look at the policy logic behind that 50% passive tax rate. It exists specifically to prevent high-net-worth individuals from using private corporations as indefinite tax deferral vehicles. This cyclical flowchart illustrates the refundable dividend tax on hand, or RDTOH. When a CCPC earns passive income, it pays that heavy 50% penalty upfront to the Canada Revenue Agency. A portion of that tax is held in a notional account by the government. This enforces the concept of integration within the Canadian tax system, ensuring an individual pays roughly the same tax whether they earn income personally or through a corporation. The corporation only receives that tax refund if it forces the money out of the corporate structure and pays it as a taxable dividend to the individual shareholder. Once that dividend lands in the shareholder's personal account, they are taxed at their highest personal marginal rate. This mechanism is highly effective. It deliberately destroys a corporation's ability to compound and reinvest capital internally because half of the profit is locked away by the government until a personal tax event is triggered. The RDTOH framework makes the CCPC a restrictive vehicle for holding sudden, massive passive wealth. For business owners about to sell, breaking CCPC status becomes an absolute economic necessity. Stripping that status requires navigating Section 125(7) of the Income Tax Act, which explicitly defines what constitutes a CCPC. This node graph maps out the defining requirement. A CCPC cannot be controlled, directly or indirectly, by non-residents or by public corporations. To legally break CCPC status, the tax planner must introduce foreign control into the corporate structure. This triggers a highly complex assessment of both de jure, or legal, control, and de facto, or factual, control. Traditional methods of doing this are heavily scrutinized. Giving voting shares to a foreign relative or a foreign partner often fails the factual control test if the CRA determines the Canadian resident is still pulling the strings behind the scenes. Furthermore, business owners refuse to give up actual economic control of their company just to save on taxes. The risk of losing their assets outweighs the tax benefit. Because actual foreign control requires sacrificing economic power, sophisticated planners require a purely legal, paperwork-based mechanism to break the definition without losing control of their assets. The definitive solution to this problem is a maneuver known as corporate continuation. This split-screen diagram highlights the mechanics of Section 250.5.1 of the Income Tax Act. Under this specific section, a Canadian company that continues its legal existence under the laws of a foreign jurisdiction is legally deemed to have been incorporated there. The company does not liquidate, it does not sell its assets, it does not physically move its personnel or operations to execute this maneuver. The directors simply file articles of continuation to effectively change the corporation's birth certificate from a Canadian province to a jurisdiction like the British Virgin Islands. Because the company is now legally incorporated outside of Canada, it instantly fails the Section 125(7) test for CCPC status. Through a highly engineered paperwork maneuver, the corporation becomes a foreign entity on paper, officially stripping its CCPC status and overriding the 50% tax penalty. If the corporation is now legally a BVI entity, why doesn't it trigger Canada's severe corporate emigration tax? Ceasing Canadian residency normally results in an immediate statutory consequence under Section 128.1, a deemed disposition of all assets at fair market value, departure tax. This composite image represents the Canadian common law test for corporate residency, central mind and management. The law dictates that as long as the directors live in Canada and hold their board meetings in Canada, the company is still a Canadian tax resident, regardless of where its paperwork is filed. The continuation creates a perfect hybrid identity. It is a legal foreign entity, making it a non-CCPC, that is simultaneously a factual Canadian tax resident. The financial outcome is exacting. The company still pays tax to the CRA, but at the 27% general rate instead of the 50% passive rate. This dual identity exploits a specific gap in residency rules, maintaining enough of a Canadian presence to avoid the departure tax while establishing a foreign legal status to bypass the CCPC investment penalty. Traditional CRA audits consistently failed to stop this strategy because the continuation maneuver technically complies with the strict letter of the Income Tax Act. To combat this, the government relies on a statutory mechanism of last resort, the General Anti-Avoidance Rule, or GAAR. GAAR is designed to negate tax benefits from transactions that technically follow the rules but abuse the underlying policy of the legislation. This presentation of the Income Tax Act shows the critical legislative amendments to GAAR that took effect on January 1, 2024. The requirement that a transaction's primary purpose be for tax avoidance is violently crossed out, replaced with a much broader standard, one of the main purposes. This lowers the threshold for the CRA to establish that a maneuver constitutes an avoidance transaction. The CRA's specific argument against the BVI continuation is direct. Moving a legal registry offshore right before a massive asset sale has zero bona fide commercial purpose. The modernized GAAR transforms what used to be a legally watertight paperwork strategy into a highly vulnerable target for claims of abusive tax avoidance. Compounding this is the implementation of new mandatory disclosure rules. Taxpayers are now forced to explicitly flag these non-CCPC maneuvers to the CRA upfront. This combination of a strengthened GAAR and mandatory disclosure shifts the burden of proof and the operational risk squarely onto the taxpayer and their advisors in the Tax Court of Canada. The entire economic risk calculus has fundamentally changed. Severe new GAAR penalties apply if the strategy is struck down in court. Historical, purely structural loopholes are facing an existential threat from judicial and legislative alignment. The BVI continuation loophole demonstrates a specific boundary in statutory interpretation, proving that in modern Canadian tax law, adhering to the letter of the law offers little protection if the transaction violates its underlying spirit.